strong top-line growth and healthy operating margins. We will continue to focus on premiumization both in India and in Europe in terms of partnering with premium OEMs and increasing our proportion of our premium sizes. Going forward, we expect earnings momentum to continue, helped by demand recovery in key markets, further correction in raw material processes, and our relentless focus on price discipline and profitability going forward. We remain committed to reach our intended margin range, and the same is highlighted by sequential improvement in margins over the last few quarters. We've had healthy positive free cash flow in the quarter, and the ROCE for the current quarter is approximately 12%, the lower end of our desired range. Profitability margin was also a little below our stated midterm target of 15%. Continuing from where I left last time, we at Apollo Tyres are relentlessly working on our 5 key pillars of our Vision 26 as we work towards an even more balanced and resilient business model. This has helped us report another quarter of strong operating margins and double-digit growth in net profit, despite a challenging environment. I would now highlight some of the work done by our teams in the quarter. Starting with R&D, we recently inaugurated Advanced Tyre Center in the R&D Center in Chennai. The new facility will further augment our testing capabilities for future vehicle models. We'll be able to fine-tune the performance of our products by simulating closely to the real-world conditions using this facility. This would also help us to reduce both time and money spent on tests at different tracks around the world. We are working with new and innovative raw materials to lower our rolling resistance. Moving to digitalization, we continue to work on new age technologies as we optimize our current processes and prepare for future. As a part of our cloud journey, we have recently migrated our primary business software, SAP, to cloud. With most of our business processes being cloud-enabled, it sets the foundation to accelerate our digitalization journey and our business transformation. We are using AI and machine learning extensively across plants, manufacturing processes to drive productivity and capacity gains. This would enable us to move to a capex light model, preserve cash flow, and improve our ROCE. We have opened a digital innovation hubs in Hyderabad and in London to further accelerate this journey, including generating new innovative business ideas. We are also launching apps leveraging state-of-the-art technologies like artificial intelligence to track our dispatches and improve our customer engagement. Another key area of focus is sustainability. We've been making more headway in this respect, and I'm proud of what our sustainability team has achieved in a short span of time. We're the first company in the automotive sector in India to receive the prestigious ISO 20400 certification for sustainable procurement. We have recorded an improvement in our CDP climate change score to B from 22 in 22. We were D in 21. Early in December 22, we also laid down further commitments in the ESG space. All of these would help us achieve our aspiration to be carbon neutral by the year 2050. I would urge all of you to go through to our website. We have also recently partnered with Tyres, a Canada-based organization, to set up processes of devulcanizing rubber in a non-chemical manner, again supporting the use of recycled material. Talking about the brand, we continue to invest in brands across our key geographies. So to start with, in India, we have launched an integrated TV plus digital media plan for the PCR category. The quarter also witnessed a visit by a few Manchester United team players, resulting in an engagement with more than 4,500 fans on the ground and online engagement with more than 22 million people. Vredestein Tyres also entered India Book of Records with a drift record, further showcasing product superiority. Moving to Europe, we released Quadtrac EV, the first all-season tire designed specially for electrical vehicles. During the quarter, we also undertook advertising campaigns in our focus markets. Our association with the 20-kilometer De Paris Marathon was also well received and has helped us gain excellent visibility. We're also the new global sponsors of the Winter Ski Championships at Courchevel in France. Finally, the last pillar of our strategy is people. We kicked off Chairman's Recognition Week in December 22. This included multiple recognitions like Apollo Pillars, Roll of Honor, Global Learning Champions. We also initiated next batch of Apollo Laureates Leadership Development Program. This is a year-long new age learning journey supported by Skillsoft and MIT Sloan. As always, we are keeping a close watch on the markets and our cost. We'll continue to be judicious about CapEx and follow a CapEx light growth model. We will continue to focus on profitable growth and free cash flow generation. We are in fact taking the ROCE and free cash flow targets as part of our variable pay parameters across the management teams of Apollo. With this, I'd like to conclude and hand over to Gaurav. Thank you.
Thank you, Neeraj, and good afternoon, ladies and gentlemen. Continuing from where Neeraj left, let me start by thanking all our stakeholders for their support. In India, we witnessed a strong revival in the OEM demand. However, demand momentum was moderate in the replacement segment. Export markets also faced challenges. Overall, we had a sequentially flat quarter, which was also on the back largely of higher price mix. More importantly, we have continued to maintain strong pricing discipline and have even backed out of a few OEM opportunities due to concerns on pricing and profitability. While this has had a limited volume impact, it has helped us improve our price positioning among our peers. Helped by this and control over costs, we reported a significant improvement in our EBITDA margins. The Europe performance in the last quarter was impacted again by a subdued demand environment. The PCR and the TBR replacement markets declined by 14% and 10% during the quarter. We continue to outperform the market in the current year. Despite the sluggish demand environment and a challenging cost environment, we were able to maintain top line and margins on a sequential basis. More importantly, we continue to register improvement in our sales mix. The UHP, the UUHP mix in the last quarter stood at 45% against 43% in the same quarter last year. In terms of outlook, while we expect the demand in India to remain subdued in the replacement segment in near term, the OEM demand momentum is expected to remain healthy. Similarly, in Europe, while in near term there would be some demand challenges, we expect that in mid-term the demand momentum will pick up across both our markets and should result in good growth. Moving on to financial results, the consolidated revenue for the quarter stood at rupees 64 billion, a growth of 13% over the same quarter last year and 8% on a sequential basis. The consolidated EBITDA for the quarter at rupees 9.1 billion, a margin of 14.2%, improvement compared to 13% for the same period last year and 12% in the previous quarter. Given this performance, we've been able to improve our leverage ratio. The net debt to EBITDA for the consolidated operations was at 1.6x. For the India operations, the revenue for the quarter at rupees 42.5 billion was a growth of 12% over the same period last year, though flattish on a sequential basis. The EBITDA for the quarter at rupees 5.5 billion was at 12.9% compared to a 9.1% for the same period last year, and also a big improvement over the sequential quarter at 10.3%. For the European operations, the revenue for the quarter was euro 180 million, up 7% compared to the same period last year and flattish sequentially. The top line was essentially driven by improvement in price and mix. Despite a challenging environment, we've been able to maintain our market share in the quarter in the key product segments. The EBITDA for the quarter stood at euro 28 million with an EBITDA margin of 15.4% compared to a sequential of 15.3%, though a drop from the same period last year of 20%. The margins were impacted both by raw material cost push and energy cost. With this, I would conclude my opening comments. Thank you. We would be happy to take your questions.
Thank you, Neeraj sir and Gaurav sir, for the detailed opening remark. We'll now open the floor for question and answer session. Please use the raise your hand option to ask your questions. And once you are done asking your question, please lower your hand. I would ask to please limit your questions to 2 per participant. We wait for a couple of minutes for the question queue to assemble. Yeah, so we have our first question from Mr. Siddharth. Please unmute your line and ask your question.
Yes, sir. Thanks for the opportunity and congrats on a great set of numbers. Sir, my first question is on the volume. So if you can just give us some more details on how the replacement growth has been on a YOY or QOQ basis. And one sub-segment also, if you can throw some light, it has been. For the India business, sorry.
Yeah. So Siddharth, the overall volume decline for the quarter was a 4%. We did not have volume growth, we had a decline. And replacement volumes were down 8%.
Okay. Okay. So overall volumes declined 4% YOY and replacement was down 8% YOY.
That's correct.
And what will be the breakup, sir, for the segments like truck and PV in the replacement?
For truck replacement, the decline was 8% and the same number for passenger car replacement.
Understood. So, sir, on this demand outlook, just some more clarity. I mean, when you say that you expect replacement to remain subdued in the near term, now this is the second quarter when we have seen the demand remaining soft on a YOY basis. So, how should we think about the growth for the coming years for this segment?
So the volume, I think the quarter 4, you will see replacement coming back. Definitely it will come back. OE is already up both in commercial and passenger. So generally there is a lag effect that volume will start coming up you'll see in quarter 4. January has been a little bit cold, but come February, March, I believe the volumes will be back in replacement.
Okay, and this does not factor in any, I mean, is there any market share loss in this also in the truck side, or the industry would have also declined in the similar lines?
There is no market share loss. All players, you've seen sequential quarter on quarter 2 on quarter 3. We have been flattish, whereas our competition has been negative.
Understood, sir. So lastly, on the commodity side, if you can throw some light, how much benefit we can see further in the current quarter, given where commodity prices are, and do you expect any further benefit in the coming quarters also?
Gaurav, you want to?
Siddharth, we expect the raw material corrections to continue. We saw a decline of 6% in Q3 vis-a-vis Q2. and we would again expect a mid-single-digit correction in raw material prices in Q4.
Okay, sir. Got it. Thanks, sir. I'll come back in the queue.
Thank you.
So we have our next question from Mr. Raghu Nandan. Please unmute your line and ask your question.
Thank you, sir, for the opportunity. Congratulations on strong numbers. Firstly, a clarification. In terms of OEM and export, can you share what was the growth in OEM and what was the decline in exports? And also, if you can talk a little about how you are seeing the overhang on exports to continue in the near term, and what are the factors you think can aid for improvement in volumes there?
Gaurav?
So Raghu, the growth in the OEM volumes was about 30%, whereas the decline in exports in the current quarter was about 25%. As Neeraj mentioned, we are seeing bullish demand from the OEMs, and that we expect to continue. Exports, at least in near term, we think with the macroeconomic environment, the demand would be subdued. We've still had substantial growth in exports on a full year basis, and going forward also we expect some of it to come back. But near term, the export market will continue to be subdued.
Got it, sir. On the Europe replacement market, as you indicated that the industry has seen a double-digit decline both in passenger vehicles as well as on the truck side. How do you see it? How much of it is because of mild winter on the passenger vehicles and how much because of the macro weakness? I'm trying to understand whether the muted volume performance will persist and what are the factors you think can lead to a recovery, and by when you are hoping that the recovery could take place.
Should I take on, Gaurav?
Yes.
So I think the whole question is around Europe. Europe has had a slightly delayed winter. Also, market sentiment is very down, given that Europe is going through a recession. Even the US is going through a recession, where Apollo in Europe is on a very strong foothold. The market was down -14%, whereas Apollo was down only 5%, -5%. So we actually gained market share. Our whole strategy in the passenger car is to become a premium company. So our UUHP and UHP share also went up to 44-45% of the whole pie. Given that we are a very niche player, I think that's where we are trying to make market share gains in new channels, in new countries. So the focus countries are really Spain and France, whereas Germany and Netherlands continue to be the top two countries for us. UK is the other third focus market for us. So I believe that Q4 is going to be on revenue. We will have a growth because we are sticking on to our price, but on volume again it will be low. So the first 6 months of this year, calendar year, are going to be a bit challenging in Europe. Then I see things panning out.
Thank you for that, sir. On the Europe side, the lower gas prices in Europe, are we getting the benefit of it as most of our exposure was hedged?
Gaurav, energy.
Yes, the energy prices are beginning to come down. We still had an escalation in energy prices, though the hedging strategy largely insulated us, and that's reflected in the fact that we were able to report quite healthy margins, though down a little bit vis-a-vis last year. But now the prices are beginning to come back to reasonable levels and should not be a factor going forward into the next year.
Thank you, sir. I'll come back in the queue.
Thank you.
We have our next question from Mr. Jinesh. Please unmute your line and ask your question.
Yeah, hi. My question pertains to the European market. It seems the large part of impact is more on because of the inventory destocking. On the retail side, are you seeing similar pressures or that's reasonably okay?
Retail, the inventory at dealer level is high. Drives driven on the road have come down in Europe. And that was primarily because of the recession, plus the gas oil prices were very high. So slowly, things will ease out as we go into the next quarter.
Okay, got it. And secondly, in the European market, we did not see, or European operations, we did not see any benefit of commodity prices. In fact, you called it out as a factor why margins had corrected on YY basis. So can you talk about what led to the inflation on the RM side and how do you see that shaping up?
European operations usually get the impact of raw material with a lag. Also, a large part of the RM correction was initially led by natural rubber, which is a much smaller component for the European operations. So the RM correction for the European operations will come through in Q4.
Okay, so QOQ, we expect some benefit of RM coming in fourth quarter.
That's correct.
Got it. And that would be again similar mid-single digit kind of benefit like we expect in India, given that the crude-based derivatives have come off quite reasonably well.
Similar quantum.
Okay. And lastly, any update on the anti-dumping duty on TBR side in India?
So the anti-dumping duty is no longer there. But from our perspective, the other constraint, which is the tires being on the restricted list, continues.
Okay. So hence, no material increase in exports so far.
As of now, nothing.
Imports, sorry. Yeah. Got it. Great. Thanks. I'll fall back in queue.
Thank you, Jinesh.
We have our next question from Mr. Amin. Please unmute your line and ask your question.
Yes, hi. Thanks for the opportunity and congratulations for hitting the 12% ROCE mark. I think it's quite heartening to see a double-digit ROCE in the company after a long time. My first question is, on that, what is the capex for the 9 months? Because I'm guessing that if the demand environment is a bit flattish, I guess a lot of the ROCE improvement will have to come from A, margins, which should be strong given lower commodity, and B, better asset turns. So what is the capex for the 9 months and any early indications of how it could look like for next year?
Thank you. The capex, in light with what I've been talking, has been fairly low. In India, it's just around the 450 crore mark, and in Europe, just 20 million euro. So it's largely been maintenance capex into digital initiatives, etc. As of now, we are on the drawing board with our budget for next year, etc. So a little early to give you the capex guidance. We are still assessing the demand-supply situation. Unlikely that we will have any major growth capex. As we've been talking to all of you, we need to just assess our demand capacity situation on the passenger car side and see if we do need to begin any mid-sized capex next year. We'll get clarity on that in about 1 quarter. So as of now, there is no growth capex which has been sanctioned or approved.
Okay. And just to go back to the replacement demand, which, mostly Europe we understand, but in India, this truck replacement has actually been, quite weak, I think, for more than 2 quarters now. And it seems that activity level is happening on the ground. The eBay bill data and other data points seem to be quite strong. So what do you think is happening there? So is part of it voluntary, like part of the decline voluntary, like, you let go of some market share at the margin to support pricing? or what is happening? Because it seems a bit troubling. I don't know, or maybe we are worrying too much, and maybe it's not so worrying.
See, demand on the replacement side has been subdued. You're right, for 2 or 3 quarters. If you look at a YTD figure, our volumes on the truck side are just slightly negative. Given our pursuit of a very conscious strategy of profitability, we do have let go of maybe some bit of volumes, but not significant vis-a-vis overall market. The expectation with the kind of infrastructure spend that the government is planning, we think that the demand will come back strongly. The OEM side is still holding up. So yes, we would have been happier with a better demand scenario in the replacement side, but we don't see a reason for worry midterm.
Okay.
We think it's a few quarters away where the demand will pick up.
Sure. Thanks. I'll come back in the queue.
Thanks, Amit.
Here our next question from Mr. Basudev. Please unmute your line and ask your question.
Hi, thanks for the opportunity, and heartening to see Kamal sir start with focus on FCF and ROC in his initial remarks. A few questions. One, in the initial comments when you said overall volume is down 4%, is that India volume or it is the consolidated volume you meant?
India volumes, Basudev.
Okay. Second is, what's the current rate of TBR utilization?
TBR
Capacity
capacity?
utilization. Yeah.
The TBR capacity current utilization is about 80% in the last quarter.
So, will it be right even now to assume, and combined with your controlled capex and focus on FCF, that no incremental TBR capex in 24, 25 both fiscals?
That's right, Basudev. We don't expect that in the next 2 years we need a TBR capex.
Sure, that's great. Third thing, as in your presentation, the debt reduction which you mentioned, I recall in Q3 there was a spike in debt because of working capital surge, because of the reasons which you mentioned, both in Europe and India price hike related issue. So is it largely related to reversal of those working capital issues, or still scope of reduction is there?
India, we had gone up on inventory and there were conscious efforts to correct those inventory positions. So that's been done. Europe, again, similar drive, and also September, there is a seasonal increase in inventory. So large part of that is corrected. But Europe can still improve given the slow demand. Inventory levels were still slightly higher than the norm that we would like to maintain.
Sure. And as usual, Gaurav, as you mentioned, the commodity-wise numbers for the quarter, if you can mention.
Natural rubber prices for the quarter was about 175 rupees per kg. Synthetic rubber 185. Carbon black 130. And steel cord about 190 rupees per kg.
Sure. And for Europe business, if I missed out, what was the Euro revenue and EBITDA margin?
Europe operations revenue was 180 million for the quarter, euro, and the EBITDA margin was 15.4%.
And as initially you highlighted that this being a winter quarter, and for what various reasons, the typical winter quarter margin where QOQ improvement one could not realize, and this weakness in margin next quarter where it is no more a winter quarter stuff, so the margin typically reverses back. So from that angle, is 15.4 coming back to somewhere around 12%. Is that possible?
We would not give out margin guidance. And yes, Q3 margins are typically our best, and clearly we did not see the sequential improvement in margins. Some of the cost push, as I mentioned, for the European operations in terms of raw material and also energy would start going off. Where it would end up in terms of margins, we would not like to point to a specific figure.
Sure. Okay. Thanks. That's it from my side.
Thank you.
We have our next question from Krisha. Please unmute your line and ask the question.
Hello.
Yes,
you're
Krisha.
welcome.
Yes, good afternoon, sir. So wanted to check when you said volume degrowth of 4%, and we have a sales growth of 12%. So it is because of price hike or the product mix?
It's largely price hikes and also a little bit of input of product mix.
Okay, so going forward, Q4 onwards, we will not have any price hikes since we have not taken it off late. So, and the volume growth is also very muted. So the revenue should be flat. Is my assumption correct?
So the numbers and what you are talking about is year on year. But you are
Yes.
right, there would not be any price changes on a sequential basis. Whatever will come through on a sequential basis would only be volume led.
Okay, okay. And for year and year also, there won't be any price increase, no? Or still because?
We did take some price increases in the early part of the year, which would flow through vis-a-vis fourth quarter last year.
Okay, okay. And so over last 2 years, we have controlled a lot of cost. Like we can see the other expenses also coming down. So that way, how much more operating leverage is left in terms of, because our margins have also expanded substantially.
Currently, Disha, our utilizations are still mid 70s to 80% on an overall basis. So with demand increasing, there is definitely scope of operating leverage. We can definitely take the utilizations up as the demand increases.
Okay, okay. So, and this anti-dumping duty is not, sorry if the question is repeated, is not impacted us as of now. What is your view on the same? Because we are a major player for TBR.
So the other constraint, which is the tire imports being in the restricted category, continues. So as of now, we've not seen any jump in imports. We are watching the situation, but as of now, things are okay.
And any idea on the pricing demand if the import starts coming in? How much would be the difference between Apollo tires and a Chinese tire?
We'll have to see where the new differential is because they have had the anti-dumping duty on them. Earlier, the differential used to be a 20 to 30%.
Okay. And sir, last question, sorry. Going forward, Q4 onwards, since raw material is coming down, when you said 4% mid-single digit increase in decrease in raw material basket or increase in margins? Just
decrease in raw material basket.
Okay, okay. That's it from my side. Thank you.
Thank you.
We have our next question from Mr. Nishit. Please unmute your line and ask your question.
Yeah, hi, sir. So two questions. Firstly, Gaurav, can you give the net debt numbers for both India and the console entity? And second question is, in Europe, whatever concerns you have talked about is largely industry driven, right? We continue to gain market share. That still holds. And related to that, are you seeing Chinese imports coming down in Europe, and that is also helping us gain market share? Can you talk a little bit more about? We are focusing on some markets. What is driving the market share gain, and which tire companies losing out in that sense, and we are gaining at the expense of which companies?
Gaurav, give the net debt figure.
Nishit, the net debt in India was 4,000 crore and consolidated 4,800 crores.
So on Europe, gaining market share, primarily it is one because of our technical know-how and our technical product is very good. Secondly, given the Russia-Ukraine war, 8 to 10 million passenger car tires have been banned from coming into Russia, from Russia into Western Europe. That was banned from July 15th. And that has opened up a huge market for us. So typically, Nokian is a company which was bringing in 8 million tires into Western Europe. We have gained market share. We've gone to dealers because of the similar brand value and winter tires. That's another area where Nokian was very strong. So we've gained a lot of market share on account of Nokian.
And there used to be problem of Chinese imports in the PCR market in Europe. That still stays, or there has been some action taken for that, like they have taken in India?
No, Nishit, there's no action taken on Chinese tires. So that continues at a certain level at the lower end of the market. There are talks of action being taken, and if that happens, then there is a further boost for the domestic players.
Okay, thank you.
Thank you.
Yeah. So the next question is from Mr. Siddharth. Please unmute your line and ask your question.
Yes, sir. Thanks for the opportunity again. Sir, can you share the Refincom numbers for the quarter revenue and margins?
Yes, Siddharth. So Rifan for the quarter reported a revenue of 78 million and an EBITDA just short of 8%.
Okay. So that is quite a big improvement even in a seasonally strong quarter. This business margins?
So typically Rifan has been growing at about somewhere high single digits. In the current year, also aided by pricing, the top line growth for the 9-month period is 14%. And usually in a fairly steady state EBITDA margin of about 5%. So it's a consistently growing, steady margin business for us. It would cross a turnover of 200 million euro in the current year.
So on top of that, do you think growth should normalize, or how do you think this business?
No, the team there is always looking at means to deliver within the European context a growth which is again higher than the market, like our usual manufacturing and sales marketing operations. So they also take the target of typically delivering a top line growth of high single digits or a double digit.
Understood. And sir, on the capex numbers, you had initially guided for this year about 9 billion capex for the India and about some more here.
We'll probably end up, Siddharth, at about 75%. And the reason why we spent less is given that the margins were lower than our desired benchmarks to begin the year in the first 2 quarters.
So the next question is from Mr. Ashutosh. Please unmute your line and ask your question.
Yeah, sir. So, what is the utilization level of PCR capacity in India and Europe right now? Like for last quarter?
Just 1 minute, Ashutosh.
Yeah.
So currently for PCR for last quarter was just above 80%.
Okay.
And this was India.
Europe?
And Europe was closer to 90%.
Okay. Okay. So we still have room in India. Europe probably is close to capacity, but demand over there is weak right now. Also, we announced that we are taking 3% price increase in PCR. When was this taken, and did the competition follow over here?
This was taken only in the PCR category. We are broadly one price increase ahead of the competition. And we've continued to do that following the strategy of profitable growth. And that's also reflected in the kind of margin differential that you see vis-a-vis our Indian peers.
And this was taken in the third quarter, I mean, the October, November, or after that?
Third quarter.
Okay. So my question is on this PCR side, because as we have been spending higher on R&D over last 10 years, and also now last 2 years, we've been taking lead in price increases. Do we think that we are in a position to command some premium PCR like we do in TBR segment right now versus the peers?
Yes, so as far as Apollo is concerned in India, we are a premium segment tire when compared to the Indian players. Okay. And so if I'm 100, then next it would be MRF at 94, 95. But then when you look at the MNCs who are selling in India, a Bridgestone would be at 108, 110. So for that tire, that specific SKUs, we have introduced the Vredestein brand. So Vredestein then will start targeting the MNC brands, the international brands that are in India, and Apollo is fighting the Indian brands.
Okay, so PCR also you have leadership in pricing right now.
Yes.
Okay, and we mentioned that exports declined by 25%. This is in terms of volumes or value?
Volume.
And this is largely driven by Europe only, or other markets also are weak for us?
All markets have seen softening. In my opening comments, I did also say while we made hefty growth in North America, but currently North America dealer inventory is high. So we are anyways a very small base. We are coming from a very small base. You'll see heavy growth in North America. But currently, all markets, including Middle East, ASEAN, Europe, and US, are currently down.
And we may also mention in PPT that we have gained some 400 basis point market share in OST tires in Europe. So is it like, say, is it like one-off, or we are doing something differently? And how is the OST market overall in Europe?
So OHT market, in fact, is very down in Europe. Whereas Apollo, I mean, Vredestein enjoys a very premium positioning. We have come out with some latest new generation products in Europe. And so here we have a very, very premium pricing of 91, 92 to a Michelin of 100. So Vredestein is gaining market share, but last quarter the market has been down.
And these products are made in Netherlands only?
Some, the high-end ones are made in Netherlands, and then some come from Kerala.
Okay, and are we thinking about ramping up Kerala for OST?
Right now, we are not thinking of any ramping up, no.
Okay, and lastly, on working capital, we have seen the debt declining from 5,500 to 4,800 in this quarter, on a quarter-on-quarter basis. So how has the working capital come down, and can we see further reduction going ahead?
Yeah, Gaurav.
Ashutosh, working capital has largely reduced. There is some bit of, as I said, a higher inventory than the norm in Europe. But large parts of the correction on the working capital side were put through in this quarter.
Okay. So, okay, that would be all from my side. But with just one question on this CapEx side, next year, when we take up this PCR capex, still on drawing board, will it be a capex spread over 24-25, or this will be 1 year only, 24?
As and when we decide to take it up, and still early days, so it's not a sure shot that we will take it up. We are reassessing with the current situation, the demand, but it would be, whenever we start, it would be spread over 2 years.
Okay, that's all from my side, and thank you and all the best. We can have some closing remarks from Mr. Kanwar, and then we can close.
So no more questions, huh? That's what you're saying?
Yeah, no questions.
Okay. So once again, thank you everyone for joining us. Hope to see you after Q4 results. I can only tell you the company is on a very strong footing now. The foundations are very strong. Just waiting for the markets to open up and you will see better results. Thank you. All the best.
Thank you.